Good afternoon, everyone, and welcome to today's Professional Advisor Working Lunch, brought to you with our partner, Baillie Gifford. I'm Katrina Lloyd, Editor-in-Chief of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. I should inform you the session's been recorded and we'll send you a link of the recording by tomorrow. Do feel free to share this with colleagues. And as usual, today's lunch will qualify for 1 hour of CPD, and we'll be sending you proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session today. Markets rarely move in straight lines. Inflation spikes, policy pivots, and geopolitical shocks can push asset classes into sudden synchronicity, leaving many diversified portfolios feeling anything but. I'm joined today by Holly Mackenzie. She's Client Relationship Manager with the Baillie Gifford Managed Fund team, who believe that over time, disciplined asset mix decisions, systematic rebalancing, and uncovering off-index opportunities can help clients keep on course when headlines turn hostile. Over the next 40 minutes or so, she's going to explain how Baillie Gifford aims to cut through the noise to examine the enduring power of diversification across asset classes, regions, and industries. We'll discuss why correlations climb in a crisis and use real examples to show how a long-term perspective and learning from mistakes can stop investors abandoning their goals at precisely the wrong time. Do feel free to put your questions to Holly using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. So just before I hand over to Holly, let me quickly run you through our learning objectives for today. By the end of this session, delegates will understand how a broader opportunity set and a disciplined approach to asset allocation can cushion portfolios against volatility, learn why time horizons matter when making investment decisions during crises, and find out where Baillie Gifford is looking for growth. So that's the CPD covered. Let's hear from Baillie Gifford's Holly Mackenzie. Afternoon, Holly, handing over to you.
Everybody, just waiting for the presentation to load. I think we're good now. So thank you very much for giving up your lunchtime to hear from me. As Kat mentioned, I'm going to be presenting on staying balanced amid volatility, the benefits of diversification in an uncertain world. Kat's already gone through the objectives with you, so I won't repeat myself, and I'll move straight to correlation. So I want to start with correlation because this is the principle that frames a lot of managed portfolios, balanced portfolios like the one that I work on, the Baillie Gifford Managed Fund. And this is the idea that when equities drop in value, that will be offset with a gain in bonds. And this helps smooth client returns and it helps smooth out that volatility, giving us an easier ride. And this has been the case for much of the past 40 years that we've been running the fund. But in times of peak volatility, so crises, these negative correlations can break down, resulting in a drop in value in both equities and bonds, which can be a negative experience for our clients, as you know. This happened most recently in 2022 when the value of the managed fund dropped. So to put that in context, 2021 was a really strong year of performance for us. We were in the COVID pandemic, and as governments pumped the system full of money, this created a lot of surplus demand, raising the prices of everything, not just the growth equities that we like to invest in. And then come 2022, all of this money, this demand, created a lot of inflation, and central banks began raising interest rates for the first time in a long time. There were also added shocks. So the Ukraine war, the emerging crisis in the Middle East, and supply chain issues off the back of COVID. And this resulted in a huge drop in valuations in both growth equities and bonds. So crisis and the correlation broke down. We also felt this more recently on Liberation Day. So when Donald Trump announced sweeping tariffs across his allies, his adversaries, and pretty much everybody in between. Equities fell, so did bonds. And why was this? So in those times of peak uncertainty, where we don't know where to go, it can be a natural reaction to park our money where we feel it's safest, in those safe haven, perceived safe haven asset classes like cash or gold. But I'm here to tell you that over the long term, we don't think this is a great strategy. And the reason for this is here. So these are the long-term returns of the Baillie Gifford Managed Fund against a basket of our peers and cash. And as you can see, from the 40 years we've been running this fund, we've been hit time and time again by crises. Black Monday was just 6 months after we started the fund. Then we had Asian crisis, tech bubble, flash crash, GFC, Greek debt, Russia, Ukraine, you name it. There have been loads of shocks over the last 40 years. But we've kept a long-term view and we've stayed invested. And the managed fund has returned almost double that of the average of peers and quadruple that of cash. So it's really important to keep a steady hand. Also, if you were trading in and out in this period, you would have disrupted the compounding that we know is investing's best kept secret. So behaviorally, this is really difficult to do, to stay balanced. And how do we do it? So at Baillie Gifford, if you know us, you know that we concentrate a lot on time horizons. So I'm going to show you a share price chart over a 6-month period of one of our best investments in the fund over the past 5 years. So you can see that between January and July for this particular company, it was a rocky ride. So the stock goes up, it goes down, it goes up, it goes down, it goes up, it goes down again, and so on. And if I was looking at my Bloomberg screen or my news flow for this particular stock over those 6 months, I would be feeling really nervous. I'd be wondering, is now the time to sell? But if I acted on my instinct, I would have foregone all of this. So it's maybe a little bit clearer to you now what this stock is. And it's NVIDIA. So if you compare that 6 months from January to July in 2018 to the breadth of this chart, you'll see it looks like just a small blip in what is the long-term story of NVIDIA. NVIDIA has been a great investment for our clients. It's generated around about 2,500% return since we bought it in 2016. But to hold on this long has been difficult. And the way that we do it in Baillie Gifford is first, we try to pick great companies. We research them well in advance. So we started researching NVIDIA as a house in 2013. It took us 3 years of debate, discussion, analysis to make the decision to buy it for the managed fund portfolio. When we bought it, we developed a 5-year investment case. Any company that makes it into the managed fund has to be able to double our clients' return over 5 years and beyond. So we're constantly appraising what this looked like for NVIDIA over those 5-10 years and so on. And it paid off, as you can see on the share price chart. The other thing we do is we like to take ourselves away from the noise. We try to retain that long-term perspective, and that's easier for us in our Edinburgh HQ. We're away from the melee of London. We also look for differentiated sources of opinion. So we're not so concerned about those flashing red lights on our Bloomberg screen, rather thinking about where we can get different differentiated sources that help us make those active investment cases. And we're also patient. This is something that we train ourselves to do through our investment graduate training program. We like to hire our investors through the program, and many of our investors have spent their entire career at Baillie Gifford, trained in what it takes to take a long-term view, to stay psychologically balanced, to always keep thinking about what the future payoff could be, and thinking about how that ties back to the investment case today. But we also care about staying balanced in the traditional sense. So diversification. So this is the managed fund portfolio. We have a large allocation to equities, around about 75%, because we expect them to drive capital growth over the long run. But we also have a decent amount, 25%, in bonds and cash. That's there for ballast, but it's also there through our active bond picking process to add to returns in its own right. We build the portfolio relying on the regional expertise and fixed income expertise of our different investment teams at Baillie Gifford. So each of those different colors you can see on the pie chart represents the ideas of a discrete team. They have spent their entire careers researching the same region or asset class, getting deep into the sectors, understanding the trends that are shaping their region, and choosing the best growth companies they can find, whether or not they're in the index. They have to meet that 5-year doubling of money, have a decent probability of achieving that to make it into the managed fund. Because we train our investors all in the same way, we think they're equally capable of finding great growth ideas wherever they are across developed and emerging markets and government bonds and corporate credit. So we give their ideas equal exposure in the managed fund portfolio. We have roughly equal weightings to UK equities, Europe, North American, and EM and developed Asian equities. And then again in our fixed income exposure. So half in corporate credit, half in sovereign bonds, because we want to back the expertise of the individuals that work on this fund. We also think our active process is a great way of adding diversification. So because we're not trying to stay close to the global equity index, that allows us to go wherever we're finding ideas. It allows us to use that expertise to surface things that may not be obvious, underappreciated sources of growth. And it can allow us to take a different view. To beat the index, you need to be different from that. And we really think that our active decision-making process adds to that. Over the top, so you have ideas coming from the regions and the bond teams. And then across the top, we have regular asset allocation meetings where we think about the opportunity set at a higher level and we tilt the portfolio based on the opportunities that are coming through from the different regions and bonds. We do that on a quarterly basis and we can be more reactive. So when something big happens in markets, we can make a decision there too. So that's a little bit around why we think staying focused on the long term, being, I guess, behaviorally balanced is important, and also what we think balance through diversification can add. But we're also excited about what comes next. So I started off the presentation by talking about NVIDIA, and NVIDIA has reappeared on this slide here. So in the managed fund, we like to invest in structural trends that we think are shaping the future of the global economy. Where these trends are intact and progressing, we think they'll throw up lots of opportunities for great growth ideas. But we want to be in the right companies for today, and those are always changing. NVIDIA is a great company, and we think that its chips are integral to the AI revolution. When you've thought about AI for the past 2 to 3 years, NVIDIA is probably within the stock that's on everybody's lips. And without NVIDIA's chips, many of the developments in AI that we've seen just wouldn't have been possible. But the valuation, is now much, much higher than it was in 2016 when we bought it. And we think if we want to double our money, our clients' money, over the next 5 years, that's a much harder task. So we're looking for what comes next in AI, and Globant is just one company that we think will be a winner in the next 5 years. So this is an Argentinian IT consultancy. And what they do is they help other companies, multinationals, make the most of emerging tech. So if you've ever been to a Disney theme park, you will have been given a wristband, and that wristband manages your entire customer experience. So your car parking to buying your burger in the Disney canteen, or managing your place in the queue for your favorite roller coaster. Globant is the company that does all of the kit behind that AI wristband. It does loads of other things too, so great partnerships with Spanish Football League, La Liga, Formula One, and Nissan. And we think Globant is going to be the type of company, the next generation of AI beneficiaries that helps others make the most of this new and exciting technology. It's not just AI though. We like to build a diversified portfolio, so we're looking for lots of different opportunities across different trends. So healthcare has been a big one for us in the Managed Fund and Baillie Gifford. So what will it mean with more personalized medicine? Is there a cure for cancer coming down the line? We've sold out of CRISPR, and we've bought Novo Nordisk, a Danish company that we think is at the forefront of combating obesity worldwide. Climate change, again, is a big issue that we have to contend with as participants in the global economy. We've reduced Tesla, which has been one of the winners the past 10 years. And we've bought Daikin. This is a Japanese air conditioning company that we think will help us cool our homes and our buildings in a much more efficient way in the future. And one of the big benefits of the Managed Fund is regional innovation. So finding, uncovering those great regional ideas. And Moonpig is a homegrown UK example. So it's changing the way that we send gift cards and celebrate birthdays with our loved ones and big events. So that gives you a flavor of what we're excited about today. I think I'll pass back to Kat now to sum up.
Hi, thanks very much for that, Holly, taking us through your thinking and those areas there. Before I go over CPD again, we do have a time for a few questions here. So we've got a few that have come through, and I would again encourage you to also put any questions up as well that you may have. Yeah, so we've got a couple of questions here about those learnings you were talking about, the crises and the history of the fund. What have the managers learned through the prolonged period where growth was hurting? In hindsight, would they consider other defensive measures for future shock events? Also, what have you learned from the experience of the last few years? Would you do anything different under similar circumstances? So yeah, just something about what you've learned from those periods and what that's meant for how you manage the fund.
Absolutely. I think there's a couple of things that I'd like to touch on. First, around the resilience of the portfolio and the work we've been doing there, and then also about some of the recent asset allocation decisions that we've been making that have had that sort of defensiveness in mind. So first of all, on resilience, so we believe that the era of low interest rates has now come to an end. And the type of growth company that is going to succeed in this new market environment is going to be one that is really quite different. So we've thought a lot about the foundations of the portfolio and the companies that are in there, the fact they need to be strong, they need a little bit more protection. So we've increased the profitability of the names in the portfolio. If you went back to 2021, this was maybe around 70-75%. It's now up near 95%. So big focus on companies that can fund their own growth. We've also ensured that the companies in the portfolio are holding a lot less debt than the market, less than half that of the market average. And we have an investment grade bond portfolio in average. So the average credit rating across managed fund bonds is BBB. But if you know Baillie Gifford well, you will know that we're all about earnings growth and sales growth. So we think companies that consistently grow their earnings and their sales over the long term are the ones that will be rewarded by the market in terms of share price. So we're also ensuring that we're not compromising on that earnings and sales growth either. So that's a little bit about the resilience of the portfolio. And then we have been a little bit more cautious in our asset allocation more recently. So we're around about neutral. So for us, that's 75% equities, 25% bonds and cash. And that's given the uncertainty that we're seeing in markets. We don't want to take any big bets, given we don't know where things are going to go. Within that, we reduced US equities at the tail end of last year, and we reduced it again further prior to Liberation Day, which turned out to be a good idea. And that's given where valuations were in the US, lots of questions around what was going to happen with tariffs, thoughts around business certainty as well. So we've been a little bit more cautious there. More recently, we're feeling a bit more positive in the US. We think we could add back a little bit. And we've also gone within the bond section, slightly overweight to government bonds. So we want a little bit more of a steadier allocation there.
Great, thank you very much for that. We have got a couple of questions about the US. There's obviously been a huge talking point this year, as you mentioned, the impact of Trump's tariffs Liberation Day, and also there's longer term questions about US exceptionalism. We've got a question here: is the taco trade still going strong? That idea around Trump always chickens out, and we've seen markets respond to that. Yeah, and also a question. Well, let's do that first, maybe around kind of the longer term prospects for the US. As you say, things have started to come back a bit from those early days post Liberation Day, but there's a lot of long term concerns, aren't there, around what this could mean for longer term relationships that the US has with its trade partners and defense partners as well. How have you been kind of adjusting your thinking?
Yeah, so as I mentioned in my portfolio, we are patient long-term investors. So when anything happens in global markets, we like to take our time to decide really how this is going to play out. So for us, this change in the global trade order, or possible change in the global trade order, is really quite new. In terms of, to talk about tariffs a little bit, the way that we're looking at tariffs is really going back to our bottom-up stock selection process and thinking about what is the implication of additional trade restrictions or costs on every business in the portfolio, and then thinking about whether or not this is a material enough risk to change our investment case. And then on the basis of that analysis, we're thinking about what our position selection should be, whether or not we want to retain these investments in the managed fund. For us, because we like to give equal exposure to our equity and fixed income managers, we always have a US allocation that is round about 20%. We can flex that as we can with other regions based on the bottom-up ideas that are coming through, but we tend not to take big macro calls. Where we're a little bit more involved in the macro, because we need to be, is in the bond portfolio. And as of today, we're long US dollar because we think that US dollar will come back eventually.
Yeah, we had a question about that. Do you think the US dollar will recover its 10% plus losses? So yeah, thanks for answering on that. On what about the UK market? A lot of talk here around trying to stimulate growth and getting investment there. What have been your views of some of the companies, UK companies? You mentioned a couple in the presentation, but what's the kind of team's view on the environment here and some of those companies you like?
Yeah, so we have around about neutral, slight positive allocation to the UK in the managed fund. We think the UK does offer opportunity. Valuations are very low relative to other asset classes, so you think you could get a bit of a boost there. But also the businesses that we own are international businesses, so they're London listed, but often it's not a play on the UK economy. Rather, it's a growth opportunity outside of the United Kingdom's borders. In terms of the United Kingdom economy more generally, we think that inflation, we think it's not bad. We think inflation is modestly above target. We think our sovereign bond team thinks that there may be room to cut interest rates a little bit in the UK. And the outlook for the companies we're positive about. I think those would be my comments on the UK.
And let's look a little bit about some of the holdings there. And we were chatting before, and you were mentioning Amazon. It's back to being the biggest holding in that you have. What's the sort of case from here? And maybe you can give us a bit of insight into your thinking around that company.
Yeah, I'm pleased that you brought up Amazon, because I think for the people viewing the webinar, there's an ability to click on an article that we've recently written that goes into some of our top ideas across the different regions and fixed income asset classes, and Amazon is mentioned in that. So Amazon's a big holding for us. It's the largest holding in the US part of the portfolio. And the investment case for the next 5 years for Amazon is really based on the strength of its e-commerce business, but then also its cloud computing. So Amazon is the leader in e-commerce in the United States, one of the world's biggest markets, and it's the global leader in cloud computing, so Amazon Web Services. We think that business will continue to innovate as it has done. It's doing really interesting things in terms of warehouse robotics. It has fleets of robots that are operating in its warehouses to get parcels to the consumer faster. And it's also doing really innovative stuff with AI and cloud as well. So I think it's a more challenging thing for our investors to create an investment case that's based on doubling your money for a company that size. But we think Amazon is executing well and progress is good. Very confident in that name.
And you mentioned, obviously, you've been looking at AI names and the AI theme from an earlier point than other investors, have been looking at it. But we seem to even be now still at the very early stages of what AI can do. Every presentation we've had at the conference being about the potential and the speed from here. How does that impact your thinking, not just on names that are directly tapped into that theme, but for all the companies in your portfolio, how they're integrating AI with what they're doing and what that could mean for their businesses and sectors? How does the team kind of look at this?
Yeah. So we're really excited about AI, both as an investment opportunity and as an opportunity for our business. So we're using the tools internally to improve some of the tasks, the routine tasks that we do every day, but also as an augment to our research process. So that kind of basic information gathering, we can find that happens much faster with AI rather than having a human do it. So we're excited about AI internally, and then how do we think about AI as an investment opportunity? So I think there's probably 3 areas. There's the companies that are making the picks and shovels, so the hardware that goes into AI, NVIDIA being one of those, but TSMC, another big holding in the fund, the Taiwanese high-tech chip manufacturer. That's another opportunity there. Then there's the companies that are at the first stage of building AI models, so the likes of Meta, which makes Llama, OpenAI, ChatGPT, and the others. And then there's that next generation, which are only just coming to the fore. So ones that are deploying AI in exciting ways to improve the offering that they already have. So a good example from the managed fund is Shopify. So this is a Canadian e-commerce business. It helps small and medium-sized merchants sell stuff online. But it's using AI really interesting ways to improve its merchant experience, to get better information on how customers are buying products, and to accelerate some of the tools and the processes that it sells to its customers. So that's really how we're seeing the process of AI developing. We also think that while, I guess up to now, the story of AI has been very US centric. So a lot of the companies that have been big winners have been based out of Silicon Valley. We're seeing that being disrupted now. So we had China's DeepSeek model released in February. That was difficult period for US tech stocks because it showed that it's not just about the US anymore. Other countries have got a stake in the game, like Globant. So that's an Argentinian business that we think will help others improve their operations as a result of AI. And indeed, Moonpig. So I mentioned Moonpig on the slides as well. One of the reasons why we really like Moonpig is because they have a fantastic data science offering. So they're analyzing everything they do with their customers, every interaction they have, everything their customers buy, to make sure that they're at the forefront. They're really selling stuff that is exactly what people want. I don't know if you've sent a Moonpig card recently, but it will prompt you just in case you forget your grandmother's birthday, for example. So those things are really adding value through AI and data.
I still post my cards, but I feel that may be coming to a bit of a feel there may not be much longer left for that opportunity. But no, it's interesting what you're saying about data there, especially and how they're all using it. And what about valuations? You mentioned that in the presentation, particularly for these AI names, and how does the team kind of assess that in particular?
So it's always on a case-by-case basis, and it's when we see a big spike in valuations. So we saw this with many US equity names at the end of 2024. If we see a big uptick in valuations, that prompts us to review, and we think, has anything really changed in the investment case? Is this material? Have we hit our target earlier than we would have thought? And then it's, if we can still build that sort of doubling our money case from today's standpoint, we will remain invested. But if that probability looks narrower, or if something else has changed, we'll review our position.
And maybe you can say a bit more about the fixed income part of the portfolio, the managers kind of involved with that. You mentioned that active process that you have on there. Maybe you could just say a bit more about how that's put together.
Yeah, absolutely. So this is something that we think is a selling point for the managed fund, and something that we do differently from some of our competitors. So as active stock and bond pickers, every investment in the managed fund is analysed in-house, often over a period of years before it enters the portfolio. This applies to equities, but also bonds. So some of the other funds in our universe get their bond exposure through passive indices. You won't find that at Baillie Gifford. Every idea is the result of discussion, debate, and they need to be able to provide that ballast, but also a return in their own right. And the fixed income part of the managed fund portfolio has performed well. It's added to absolute and relative returns over the past year. So we think this is something that sets us apart.
And obviously it still has that bring that discussion with the equity managers as well, because they can add different things to that discussion, can't they? Coming at it from a different angle, looking at companies, looking at big issues going on in the world as well.
Yes, you're correct. So the way we do it, we have our regional teams and they construct sleeves in using their own expertise. So our US manager will construct a US equity portfolio, our UK manager will construct a UK equity portfolio, our EM manager, and so on. And then we bring those together, combine those to create the whole managed fund. But then we also have discussions in our regional equity group and our fixed income group about what the prospects look like for each region, how we're feeling about developments, how this perhaps influences other people's parts of the portfolio. And then we have a further discussion in our asset allocation process that involves the fixed income managers and the equity managers, led up by our lead fund managers, Stephen Hay and Ian McCombie, who each represent their respective asset classes. Ian McCombie for equities, Stephen Hay for fixed income. And that's really to bring everything together. So how are these individuals with different specialist subjects, as it were, thinking about the portfolio developments in global markets and how this impacts the overall trajectory of returns, so that we can tilt where we see the opportunities arising. Or indeed, as it is now, because we feel that there's still a lot of uncertainty out there, we've got quite a large allocation for us to cash. We've got about 4.5–5% in cash. That's because we want to be nimble when those opportunities arise and have that dry powder there to plug into things as they come up.
Yeah, I was going to ask you a bit about your pipeline of ideas. Presumably you're monitoring and reviewing names that you're keeping an eye on, and what's your kind of watch list? How do you go about? And then what would be your, obviously the team would then need to be convinced to actually take a position there, but how long might you be looking at a stock for before you might go into it?
Yeah, so it depends, but typically a year plus. So with the likes of NVIDIA, that was 3 years from initial research report into buying. It goes through a lot of different rounds of discussion within the team that is looking at the idea. The teams, the regional and the fixed income teams, have total autonomy over what they buy. So there's no sign off required from Ian or Stephen. We back the conviction of our experts. So as long as those teams think that this is a great growth opportunity based on their respective asset class, there's no additional hurdle to go through to see it enter the portfolio. But we need to be cognizant of what else is in there as well. So we want to make sure that this is the right basket of opportunities. Also thinking about risk. So thinking about, if I add this sort of name to the portfolio, how does that interact with others?
Yeah, it's helping that overall resilience there as well. Just finally, you mentioned a lot of those longer term themes and really looking forwards, but as you said, it's a very uncertain time for investors. Coming into the second half of the year, we're just about there now, coming to the second half of the year and going forwards. What are sort of things you're excited about? What do you see will still be big discussion points with the team?
Yeah, AI is a big one. Already talked about that a lot. I think what we are very excited about is the opportunities that will arise as a result of changing, I guess, regional trade patterns. We think this is tariffs are destructive, and we think this is a disruptive time for the global economy. But with those changing patterns, it may provide opportunities for other types of company to become regional winners. You may not see that same sort of, I guess, global reach that we've seen in the past sort of 20 odd years. I think you're getting that a little bit with China. So Chinese companies, some of the best Chinese investments in our portfolio tend to be domestic focused. So thinking about companies that can really win through the strength of the Chinese consumer. Likewise, in the American part of the portfolio, a lot of those are domestically focused stocks as well. So with the managed fund, hard to pin down one trend or theme, and we're not thematic investors. It's rather looking for what are the attractions of these particular regions and what can we find that is different to the index and potentially grow over those 5 years that we're looking at.
Yeah, and I think it's interesting as well what you were saying about the behavioural element for investors. It is very, very hard, isn't it, over those times of crisis that you highlighted to sort of stay the course, and you've got a lot of experience of that. But I think that seems to be that's going to be the biggest test, you know, as we've seen over the last couple of months since Liberation Day. That's really a test for some of these strategies, isn't it?
Yeah, absolutely. And yeah, it's not easy. But we do have a team-based approach, I think, at Baillie Gifford that sets us up well. So nobody's making decisions in isolation. Rather, everybody is supporting, or our investment managers are supporting each other as a team. So I think when we're thinking about these big changes and how do we stop ourselves from getting caught up in the sort of endless news cycle, it really benefits to be part of a team, to have that perspective, to have our more experienced investors alongside our more junior investors. Most of our investment staff sit together on the same floor in our office in Edinburgh. So it really is a sort of collegiate environment that helps in times of crisis, especially.
Yeah, and just finally, there's obviously been a lot of talk about broadening, about diversification, especially in the last few months. And but I mean, just in terms of just to be clear about where you're invested and where you're not, I suppose you don't have unlisted assets in this fund, which other Baillie Gifford funds do, and it tends to stick to your equities, fixed income, cash. That's where you've decided to focus this particular fund.
Yeah, absolutely correct. It's all publicly listed equities, bonds, and cash.
Yeah. Was a temptation to try and go into other assets, you know, that diversification element, or do you think for your clients, this is what they'd expect and what you're kind of sticking to with this? You think you can still do that, build that resilience with where you decided to invest?
Absolutely. So we have run the managed fund since 1987 as per the same philosophy and process. So looking for the best bottom-up ideas in fixed income and equities, finding the best growth wherever it is across developed and emerging markets. And we think that the long-term returns for the fund, so around about 8 or 9% per annum over that very long run, speak for themselves. We believe that this process can work, and we're not seeking to diversify through other types of assets.
Great. Well, thanks so much for answering those questions and taking us through that. Just before we wrap up, let's have a look at those learning objectives again. I'm just bringing them up on the screen now. You should be able to see the slide in a moment. So by the end of this session, delegates will understand how broader opportunity set and a disciplined approach to asset allocation can cushion portfolios against volatility, learn why time horizons matter when making investment decisions during crises, and find out where Baillie Gifford is looking for growth. Thanks again for taking our questions, Holly, and for joining us today. If you do have any extra questions, then I'm sure Holly and Baillie Gifford will do their best to do so and answer them after the event. And just a reminder that the CPD will be delivered tomorrow. Just before we close, a quick teaser of what's to come from other PA events over the coming months. We've got a couple more online working lunches for you during the summer. The first is on the 9th of July. That's in association with Schroders. And we're going to be reviewing the results of their 2025 Advisor Pulse survey, which is always a popular session. On the 23rd of July, we'll be back with an update on the Baillie Gifford UK Growth Trust. That's with their head of UK equities, Ian McCombie. Following the summer break, we're back on the road again with our autumn multi-asset and MPS roadshow. We'll start on the 10th of September at a brand new venue for us, Wetherby Racecourse. On the 11th, you'll find us at our usual Cheshire venue in Warrington. And the following week, we'll be at the Vale in Cardiff on the 16th, Bristol's Magnificent Lee Court on the 17th, and we'll complete our roadshow in London on the 18th. And we've got presentations and speakers from Aberdeen, Aviva Investors, Downing, Quilter, Rathbones, and Standard Life. Then the following week, we're crossing the border for our annual Scotland Investment Roadshow. You'll find us in Edinburgh on the 24th of September and Glasgow on the 25th. And again, we've got a great lineup of speakers there from Copia Capital, Downing, L&G, Orbis, Schroders and Tatton Investment Management. So all in all, that's a total of 8 hours CPD over the coming months. As ever, if you wish to find information or sign up to any of our events, you can do so by visiting professionaladvisor.com/events. That's it for today's session. All that remains is me to thank Holly once more for her presentation and taking our questions. And thank you very much for joining us this lunchtime. We hope you found the session helpful, and we hope to see you again for another Professional Advisor event very soon.